Hi, Jim Gore from Thor Wealth Management. We are officially in a bear market, especially in the NASDAQ. So we want to do some comparison of this market versus the last two big bear markets that we saw. So let's look at the first one here, which is the time period from 2000 to 2002. So this is actually, I'm using same information on both of these time periods, which is the S&P 500. And this is looking, the bear market didn't start until September 30th of 2000. If you were in the NASDAQ, it actually started in March of 2000. So it was 6 months prior to this. So if you look at this bear market for a 25 and a half month time period, the market ended up being down 45.5%. There were a couple of time periods, 2 month time periods, that the market did very well. As a matter of fact, you look in that April-May time period back in 2001, market was up 18.9%. Then again, after September 11, we had the market was up 21.6%. We saw a drip down in September 11th, and actually a week that the market closed, it closed down about 18%. But then the market started going up from there. Why? The Federal Reserve was lowering interest rates and pretty aggressive in lowering interest rates. But note here, that wasn't the bottom of the market, was not 9/11. It didn't incur until back in May of 17th of 2002 to July 23rd of 2002. That capitulation, which is the time period where people say, I give up. Some people in our industry call it the puke phase, where people say, I don't care, just sell out, I want out of the market. We saw that. So in that time period, the market was down 27.7% in that 2 month time period. One of the things that is, you look at this chart, one thing that's not on here is, when did the Federal Reserve start raising interest rates? Well, actually, they started raising interest rates in 1999. So well before this bear market. Their last raise was in June of 2000. So in this whole bear market, did they raise interest rates? No. What did they do? They actually started cutting rates. When did they do it? Back in January of 2001. So you're looking at a significant drop in the market from when the Federal Reserve started lowering interest rates, not raising interest rates. Let's look at the other recent one, which is back in 2008 and 2009, where in that time period, the market dropped 52% in a 15-month time period. A couple things here. You saw a major drop in the market with the Lehman collapse. But also notice the capitulation here at the very end did not occur. It was the last 2 months where you saw almost a 25% drawdown. Now, there were time periods that the market was up here, but what's interesting, I'm going to get into this in a minute, that's different, is that you actually saw movements over a shorter time period than you did back in 2000 and 2002. But once again, when did the Federal Reserve raise interest rates in this bear market? They didn't. They started cutting rates in September of 2007. So they were cutting interest rates 4 months before the market started going down in this bear market. Today, it's the complete opposite. We're just starting to raise interest rates. And you have Federal Reserve governors like Esther George saying that inflation is more important than the stock market. So last week, we had the market was up over 5%. And saying, hey, are we here again? Good times are here again. Well, no, let's look at what happened back in 2008. In 2008, you had several weeks there that the market was up 5% or more. Look at the returns at the last week in October of 2008. The market was up 14%. So even if you bought the dip and you caught that dip, the low part of, and you were up 14% in 1 week, you go ahead 5 months later, you were negative and you were significantly negative in your portfolio. This is what is known as a bear market trap. So one of the things that is different with this market than before, which are very important, is one, is that in the bear markets before, the Federal Reserve was not raising interest rates. As a matter of fact, they either were cutting interest rates before the bear market, like back in 2007, or cutting them shortly after the market started going down, which was back in January of 2001 when the market started going down. So you have the opposite. Fed is raising interest rates. Secondly is the movements. The movements in the stock market back in 2000 and 2002, it was longer time periods that the market would go up and longer time periods would go down. 2008, you would see it on a weekly basis. Today, not only seeing it on a weekly basis, but you're seeing some days that the market is up 1,000 points, and then literally 2 days later, it loses all the assets. This is not a healthy market with those types of movements. So this is a time period that you want to make sure you have a diversified portfolio. We at Thor are still diversified. We're at our maximum in alternative non-correlated U.S. investment assets to the U.S. stock market. We will get more aggressive when we think it's appropriate. It is not there. We have not yet gotten to the capitulation stage. And this is something that the market is different than other times, and you have to be aware of that. And the big difference is raising interest rates in a bear market type of environment. We hope everyone has a great couple of weeks. And as always, if you have any questions, reach out to us at our website or call us directly. Take care, and we'll talk to you soon.